Today, we have a very big voice joining us on the show, former Oppenheimer and Invesco voice, but now manages big money as college endowment. As you may all know, that college endowment money in America is a big category of funds, long patient capital. So Krishna Memani is joining us now, who is now working as a CIO at Lafayette College, a college endowment. He's an old-time India watcher and, of course, has keen interest and eye on global macro as well. Krishna, thank you very much for joining us on the show today. We are interacting after a long time. Good to have you on the show. Before we talk about markets, just want to understand, there's an interesting global rally which is playing out. Some of the European indices are at 52-week high. There's a sharp rally in US markets. It's in December. Emerging markets have also clawed back. But the sense is one section of the market is already jubilating that inflation could have peaked out already and economic data is turning very weak, which could hold the hand of the Fed. Is it too early for that prognosis, or do you think that thinking is in the right direction?
Well, so I think, again, we have to maintain a bit of perspective. That is, the inflationary picture, which is essentially being the driver of the performance of risky assets, has certainly improved. Goods inflation is meaningfully lower, and in the U.S. in particular, things like housing are meaningfully lower. However, I think it is too early to declare victory, and that is for one simple reason. That is the employment picture in the U.S. and wage growth in the U.S. and the stickiness of the core inflation in the U.S. is just too broad and too or somewhat entrenched for it to be called a kind of a start of a new cycle. I think what we will find out soon enough is that the Fed probably tightens one or two more times, but sits on a relatively high level of rates for an extended period of time.
So you're of the view that we could be in for higher rates and that too for longer period of time. If this indeed is the case which pans out, what could it mean for risky assets globally? Also, are we vulnerable to see more Silicon Valley Bank kind of episodes? Because if rates do not come down, then higher rates could mean asset liability mismatch or similar liquidity issues cropping up for some financials. Is that a risk also which investors should bear in mind?
Well, I think the Silicon Valley situation and Signature Bank and a couple other institutions, they were uniquely vulnerable for structural reasons of their own making, which is relying on significantly flighty deposits, cheap flighty deposits to fund a long bond book in a rising rate environment. I don't think that is the case across the board. So we are probably not going to have a financial crisis as people were anticipating after Silicon Valley Bank. But that doesn't change the fact that at the end of the day, banking system is how policy tightening works. So weakening in the banking sector and therefore credit tightening is basically the channel through which monetary policy is transmitted to the real economy. So from that perspective, I think we will probably continue to see profitability strains for the banks and in turn, credit tightening as well. So what we are faced with right now is perhaps because of the situation in the banks, growth slowing down while inflation remaining higher than where the Fed would like it to be, and therefore higher for longer is how things pan out. If you look at the bond market, however, in the US, that's not what they're discounting. They are discounting a significant Fed cutting in the second half of the year. And I think in my mind, if there is going to be another bout of risky volatility or risky asset volatility, that'll probably come about when that pricing in the bond market gets priced out, because the Fed is unlikely to cut anytime soon.
Krishna, so are you making a case that a lot of money managers and asset allocators who have dialed back risk past couple of weeks and are in running profits because markets have kind of clawed back across the world should also be are wary and should also be booking profits from time to time, because these vulnerabilities could actually bring back risk in the market. In fact, could volatility as well, and the gains could fade away. Are you also recommending that?
Well, so I think next few weeks there's really nothing that comes down the pike other than the U.S. Fed or U.S. Debt ceiling debate. I think that probably is the next stopping point. That probably unfolds in the summer. So I would say for now, the markets can continue to do well in the short run. But I think in the long run, one, because of the debt ceiling issue, which is somewhat less important. But in the second half of the year, I think the real risk is the Fed cutting that is priced in the market probably gets priced out, and that's where the volatility will arise. So I think if you have substantial gains, it may not be such a bad thing to book some of those profits. We have had a good run.
Krishna, let's turn our attention towards India, because that seemed to be in focus. IMF, the World Bank, all of them call India a shining star. Global CEOs are making a beeline towards India. Most recently, Tim Cook, of course, opening up their Apple stores in Mumbai and Delhi. You understand, you've been an old India watcher. Of course, it's a country of origin. What is your stand right now? How are you analyzing the prospects of Indian markets and economy?
Well, so I think from a growth perspective, India is by far the fastest growing a large economy in the world, and clearly there are policy changes. There are, and on infrastructure in terms of investment policy. So everything is falling in place, and that's why. And one thing we should not forget is this is at the end of the day somewhat of a gift from China as well. That is, from a global allocator's perspective and a global manufacturer's perspective, getting out of China and finding a different locale is a strategic priority. So this is the time for India, and I hope they execute it and make it really happen. I think the next 1 or 2 decades in India are going to be golden.
Lovely. That's a great point you made. Next 1 or 2 decades could be the golden period for India. Great to know that. So how would you be analyzing investment opportunity in India? What are the sectors which appeal to you? Do you run money here in your current avatar? If you could share some of your specific areas of interest.
So we actually have an allocation in India, not a standalone allocation, but a Asian growth allocation, and almost 30-40% of those assets are really in India. And the Indian growth story, I think, is very much intact. And the way we are playing it is not really buying in consumer staples or banks or things like that, but our outlook is for really sustained growth in India for a couple of decades, and we want to participate on that growth upside and finding companies that can grow and become really world-class players, either domestically or internationally. I think that's what we are looking for.
Also having this conversation at a time when the India population has overtaken China population. 1/3 of India population belongs to the youth, under 35, and there's a lot of talk about the demographic dividend. In your view, how prolonged could this demographic dividend be, and how should we as a country, policymakers, should go about harnessing it the right way?
Well, so I think there are a couple of points with respect to that. First, one of the reasons why Indian growth is going to be substantial is because of that demographic driver, and India is probably the only country where only large country where you have that driver. Everywhere else, the population is either shrinking or will be shrinking relatively soon, and China being the best example of that. But we have to be careful that a population or a demographic advantage can turn into a demographic curse as well. And the key there is employment growth. I think for India to succeed in this path over the next few decades, what we have to find a way of doing is creating jobs for a lot of our youth, people who are starting out and people who have developed skills, making sure that the productivity of that population continues to grow. And education and other infrastructure that you need to create to make that population more productive is the task at hand.
All right, Krishna, before I let you go, there is also a view globally that for a country or an economy to really prosper or for a prolonged period of time, policy making at the local level, at the country level, country leadership level, the role of policy making is also very vital, role of reforms. And this current leadership is taking some steps in that direction for sure, as global watchers say. How have you analyzed the work done so far and the reform work which has been taken and has been guided towards? What are your thoughts? Would it also yield big benefits going forward?
So, I'm not a political analyst, so I'll stick with economics. I think from an economic perspective, the government has done significant or has implemented significant policies to ensure that they can support the growth outlook. I think bankruptcy reform, kind of streamlining the banking sector, the investment guidelines and the policies related to FDI flows into India. I think all of those are very, very significant progress. Doesn't mean the challenges are still have been resolved. I think if you look at how long it takes to implement or convert a plan into an actual productive asset in India, I think we have a lot of progress to make on that front. But relative to similar moves in the last few starts, I think we have made sustained progress and hope this change continues for a while.
All right, Krishna, we'll let you go on that one. Thanks so much for taking time out for us today, talking to us on ET Now. That was Krishna Memani, a very old hand as far as global money management is concerned. He's seen cycles, so his perspective is very important and valuable for our viewers.